A very happy morning, happy afternoon, happy evening based on what time you're watching this video, friends. Friends, now let us focus on all the amendments in your GST which are relevant for your November 2023 exams. Basically, this time we have discussed the amendment chapter wise. You'll find amendments for each of the chapters separately coming. So there are around 10 or 11 chapters in which amendments are there, and you'll find it chapter wise. So it is different from the last time update of amendments. And what all amendments we are going to see? Amendments which has come from your 1st of November 2022 till 30th of April 2023. They are given. And for ease of understanding, you'll always find, like always, the old provisions will be normally given in blue color, and the amendment portion will be always given in red color, so that you can easily identify and see what was the provision before the amendment and what is the provision after the amendments. And for your November 2023, the amendments are very limited. So if you see, the total amendments per se will not be more. It will be very limited amendments. So if you have already done your lectures, whether of our classes, Vishal Jain and Praveen Jain classes, VJPG Education, Vidyapeeth, or some other faculty, no need to worry. All you have to focus is on the amendments. If you are very clear with the concepts, there's absolutely no need that you have to revisit the concepts again. So if you have already prepared for your May 23 exams, updated thoroughly with all the provisions there, then what you can do, just watch this amendment video, only see the limited amendments. You'll find amendments very small portion. Rather, the major portion of the amendments that we are going to discuss contains circulars, clarifications, and very less amendment in the sections and the rules. Very limited amendments this time. Right, so let us discuss each of the amendment. This time we'll discuss it chapter wise. Yes, friends, now let us move on to your CBIC circular on no claim bonus, which is given by the insurance company. To understand this circular, let us first understand what exactly is no claim bonus. The moment we understand that, we'll be understanding both the parts of the circular. Basically, the circular is given in two parts. The first part of the circular deals with the concept of supply, and the second part basically is dealing with this chapter, which is valuation. Now, what is exactly happening? Supposing I'm the person who's taking motor vehicle insurance for my vehicle. So the insurance company is supplying me the services for my motor vehicle insurance. So there is a supply by the insurance company to me, and for which I am paying consideration. So there is a supply, that is insurance services by the insurance company. This is the supply for which I am paying premium to the insurance company, which is nothing but the consideration for that supply. Let us assume that insurance premium amounts to rupees 10,000, obviously plus GST. This 10,000 is the consideration. 10,000 is the consideration. Now, obviously, insurance company will be giving me invoice for this transaction. To be very specific, tax invoice for this transaction. Whenever there is a supply, there is a tax invoice. So this is happening, let us assume, for all the first 4 years, first year, second year, third year, and the fourth year. In the fifth year, the same thing is happening, that this insurance company is giving me the services of insurance for my motor vehicles. Basically, we had taken the example where the insurance is for motor vehicles. So there is an insurance service which is supply, and in return I have to pay the premium. Basically, I'm talking about the same thing that we have discussed now, but this time I'm talking about the fifth year. In the fifth year, also the insurance amount that I have to pay is 10,000 for the fifth year as well. But in the fifth year, there is something else which is happening. Now understand that the insurance company is going to give it no claim bonus. because in the first 4 years, I have not made any claim, not made any insurance claim. Because of the fact that I have not made any insurance claim, and initially when I am paying the premium, I have selected for no claim bonus. What is happening? Now, this insurance company is going to pay me, this no claim bonus. It is going to pay me this no claim bonus. This no claim bonus will be in form of deduction from my premium. Supposing this no claim bonus is 3,000, this will be in form of my deduction from my premium, which means that in the 5th year, when I'm paying this premium of 10,000, there will be a deduction, and final amount that I'm going to pay is 7,000. Final amount that I'm going to pay is 7,000. So basically the question which was put in front of CBIZ was whether this no claim bonus, which is paid for what purposes? Which is paid because I have not made any insurance claim. I've refrained from making any insurance claim in the initial 4 years. Can it be called as supply? Can this be called as supply by me, that is by the person who has taken insurance, to the insurance company? So basically the first question is, can it be called as supply? Supply by whom? Supply by the person who has taken insurance, that is insured, to the insurance company. The answer to this is no. It cannot be called as supply. For a very simple reason. I was not under any obligation. I was not under any contractual obligation for not making this insurance claim. The fact is, I did not make an insurance claim is different, for which I am getting a reward or incentive. So this had no contractual obligation. There is no contractual obligation for not making any insurance claim. Assume that in the first 4 years, there was accident of my motor vehicle, I would have made an insurance claim. Now the fact is, I have not made any insurance claim. Therefore, there is a reward which is given by the insurance company to me. I did not supply any services to the insurance company. There was no supply at all. Because this no claim bonus cannot be called as consideration for refraining from making insurance claim, because there was no contractual obligation for not making any insurance claim. So I cannot call this no claim bonus as a consideration that is paid by the insurance company to me, because it cannot be said that I refrained. There was a supply of refraining from an activity. Please understand that refraining from an activity is also supply. But you cannot by any imagination tell that refraining from making an insurance claim was must. If at all there was any accident of a motor vehicle, I would have claimed that insurance claim. So there is no supply. There is no supply at all. Absolutely there is no supply. The reason is, I was not under any contractual obligation not to make that insurance claim. Therefore, refraining from making insurance claim cannot be called as supply, because there is no contractual obligation, and the amount that I get in return, not in form of getting the amount but in form of deduction from premium, cannot be called as consideration. So this no claim bonus is not supply made by the insured, that is myself in this case, to the insurance company. It is not supply. The second question, which is that, this is basically the first part of the circular. The second question, which is that, can it be treated as discount from value of services supplied by the insurance company to the person who has taken insurance? Can this be called as discount from value? And the answer to that is yes. It can clearly be called as discount from value of services supplied by insurance company to the person who has taken insurance for a very simple reason. First, let us understand that this discount is post supply discount, and for post supply discount basically there are three conditions. There should be an agreement at the time of supply. Yes, if you see the agreement in the beginning itself, there was a clear cut, there will be clear cut discussion about no claim business. So there is an agreement at the time of supply. And credit note, for this particular document the insurance company will be giving credit note. So credit note will be linked with this tax invoice. So this credit note that is there, is linked with the tax invoice. And finally, recipient has to reverse proportionate ITC. Insurance company can reverse output tax on this 3,000, and against which the recipient has to reverse proportionate ITC. So all these three conditions are satisfied. See, what will happen in the fifth year is basically insurance company will pay GST on 10,000, the fifth year premium. At the same time, it will reverse output tax, reverse GST on this no claim bonus, because it is nothing but your post supply discount, where there was a clear cut agreement at the time of supply. No claim bonus was clearly there in the beginning. And this credit note which is given now is linked with your tax invoice which are made in the initial 4 years, and the recipient will be reversing proportionate ITC. As a supplier, insurance company is reversing output tax on 3,000. The recipient, the person who has taken insurance, in this case VJ, will reverse proportionate ITC. So this is all about the circular, talking about supply in the first part and valuation in the second part. Yes friends, now let us discuss about your amendments in exemption notification and your amendment in RCM notification. First, let us focus on your amendments in exemption notification, which is 12/2017 CT rate read along with notification 9/2017 IT rate. The first of the amendment which has come out is in your education sector, where there is an explanation attached. So you already have a few explanations there in entry 66, which is about education sector. Now you have one more explanation, which is explanation 4A2 entry 66, which tells that for the removal of doubts, it is hereby clarified that any authority, board or body set up by central government or state government, including national testing agency, which is for the purpose of conduct of entrance examination for admission into education institution, shall be treated as education institution. But it shall be treated as education institution for the very limited purpose, only and only for the purpose of conduct of entrance examination for admission into education institution. Friends, for this you need to understand that there are three types of educational institution. One, category A educational institution. Second is category B educational institution. Third is category C educational institution. So category A educational institution basically talks about education up to higher secondary school or equivalent. Category B talks about educational institution for conduct of examination for getting a degree, which is for getting a qualification which is recognized by law for the time being in force. So category B is basically educational institution for getting a qualification which is recognized by law for the time being in force. And last is approved vocational skill development courses. So approved vocational courses, skill development, basically skill development courses. And when you see these three educational institutions, you need to understand this is basically educational institution. We can call it as category A, educational institution category B, educational institution category C. And it has already been clarified that when you talk about these educational institutions, even conduct of examination by these educational institution is exempted. Even conduct of examination by all these three educational institutions, whether it's category A, category B, category C, is exempted. Now, what is being clarified is If at all you're talking about conduct of examination by central government, state government, including national testing agency, for getting admissions into these three education institutions, for getting admissions into these three educational institutions. So who's conducting the examination now? Conduct of examination is by central government or state government, including national testing agency, for getting admission into either category A educational institution or category B educational institution or category C educational institution. For the limited purpose of conduct of examination, this central government authority or board will also be treated as educational institution. Will also be treated as educational institution, but only for the limited purpose of conduct of examination. So now, if you're talking about getting admission, if at all you're talking about getting admission, and for which there is conduct of examination by the educational institution themselves, even then it is exempt. If the conduct of examination is not by educational institution, if it is by an authority or board set up by central government, state government, including national testing agency, even that is exempt for the limited purpose of conduct of examination. So basically there are three educational institutions, category A, category B, category C. When you are taking education in them, that is exempt. Even conduct of examination by them for entry, that is exempt. So that was already clarified. Now what is the new addition? Conduct of examination by government, central government or state government, including national testing agency, for getting admission to any of these three educational institutions, that is also exempt, and for the limited purpose of conducting the examination for the admission into these three education institutions, this also will be treated as education institution and there will be exemption. So that is the new change that has come in educational services effective from 28th of February 2023. Now the second amendment which has come here is, it is there in your renting of immovable property services. So basically we have already discussed last time that when you're talking about your renting of immovable property, so renting of residential dwelling for use as residence is exempt, but if it is given to a registered person, it is not exempt. So basically, first let us understand what is that exemption to understand what is this explanation. Now if at all I am talking about renting of residential dwelling, so if it is used for residence, if it is not used for residence, so basically if it is renting of residential dwelling, you have to ask a question whether it is used for residence or not used for residence. If it is not used for residence, clear cut it is taxable under FCM, whether the recipient is registered or unregistered, it is taxable under FCM. But in case if it is renting of residential dwelling used for residence, then you have to ask another question whether the recipient is unregistered person or whether the recipient is registered person. If the recipient is unregistered person renting of residential dwelling for use as residence, and if the recipient is not registered, that is exemption, there is no GST. And if it is renting of residential dwelling for use as residence, but the recipient is registered, there is GST under RCM. So basically, the entry is, if at all you are talking about renting of residential dwelling, used for residence, and the recipient is not registered, it is exempt. But if it is renting of residential dwelling for usage for residence, but if the recipient is registered, it is taxable under RCM. Now, there is an explanation attached here. Assume that this recipient happens to be a proprietorship concern. assume that this recipient happens to be a proprietorship concern. Now they are clarifying that this recipient who's registered as a proprietorship concern is taking two properties on rent. One there is residential house on rent used by his family. One there is a guest house by the proprietorship concern used for the vendors or the customers, etc., etc. So now this explanation tells that if at all you are talking about a proprietorship concern where it has taken two properties on rent, one is rent for the purpose of his own house for personal purposes, then they are clarifying that this will still be exempt. This will still be exempt, though this proprietorship concern is registered. This will be still be exempt, and only renting of the guest house for the usage of for the purpose of usage of the vendors or the customers, which means business purposes, that will be taxable under RCM, for the simple reason that this has got nothing to do with business, personal purposes, and this is for business purposes. So what is the explanation talking about? If at all, this issue will only come with the registered proprietorship concern. So if at all the recipient is registered and the recipient is registered proprietorship concern, now it has taken two properties on rent. The first property which is taken on rent is his residential house, which is used by his family. It is purely for personal purposes. It will still be exempt, irrespective of the fact that this proprietorship concern is exempt, because this basically will not be claimed as business expenses. It will go to drawings. Other is renting of a guest house for the customers, vendors, etc., which is purely for business purposes. This will be taxable under RCM. So the explanation portion tells that if at all you're talking about registered proprietorship concern, and it is taking immovable property on rent, but purely for personal use, it will still remain exempt. So if you now look at the explanation for the purpose of this exemption, which is explanation to entry 12. Entry 12 talks about this exemption. This entry shall cover services by way of renting of residential dwelling to a registered person, where the registered person is a proprietor of a proprietorship concern and rents the residential dwelling in his personal capacity, not for the business purposes, in his personal capacity for his own residence for the usage of by his family. And such residence renting is not on account of proprietorship concern. It is on his own account, not on account of his proprietorship concern. So it means that basically it is for personal purposes. Therefore, GST still will be exempt, though it is a registered proprietorship concern. And if it is for business purposes, claimed as business expenses, if at all that particular renting of residential dwelling, it is for business purposes. Say for example, you're talking about guest house to be used by customers, vendors, and all. Then there will be GST under that too under RCM. So that is the objective served by this explanation to entry 12, which is again effective from your 1st of January 2023. So this is the first amendment that we have seen in your educational sector. Second amendment is there into your renting of residential dwelling, that is renting of immovable property. And the third amendment, there's a removal of an exemption where you're talking about access to roads or bridges. Entry 23A is now deleted. So entry by way of access to roads or bridges on payment of annuity, if at all it is a lump sum amount on payment of annuity, now this has been made taxable. Again, initially it was taxable, then in between it was exempt, now it has been made taxable again. Basically, you're talking about access to roads and bridges. So if you're talking about access to roads and bridges, if it is on payment of toll charges, normal. So daily you go and access the road and bridges, and daily you're paying that toll charges, that still remains exempt. But if you're going daily and you're not paying toll charges regularly on daily basis, you're paying on a lump sum basis as an annuity. So this access to road bridges on payment of toll charges still remains exempt. Access to road and bridges by way of payment, by way of annuity lump sum payment, now it is taxable. Access to road bridges where the payment is by way of annuity, a lump sum payment, now it has become taxable. So that is your entry 23. So basically these three are the changes in the exemption notification, and the fourth one basically is a circular. So if you see the circular, the question of the circular is pretty simple: whether GST is payable on accommodation services which is given to air, which is supplied by the Air Force Mess to its own personnel. Accommodation services by Air Force to their own personnel. Now understand that when you see the exemption notification where the services are given by government, it covers that services by central government or state government or union territory or local authority to any person other than business entities is exempted. Obviously, there are few services given by government, whether it is to business entity or non-business entity is taxable, like your postal services, transportation of goods, passengers. But other than that, if at all government is giving services to any person other than business entities, which is not for business, profession, industry or commerce. So you're talking about giving services by government to any person other than business entities, that is exempt. There are few exceptions like postal services, transportation and all, but generally it is exempt. Now understand that when you're talking about accommodation services which is provided by Air Force Mess or similar mess, like your Army Mess, Navy Mess, paramilitary or police forces, to their personnel or any person, is covered by this exemption notification as it is not giving to a business entity, is giving to a person other than business entity. The only criteria is the supplier should fit into the shoes of your central government, state government, union territory or local authority. So in this example, when the services are given by Air Force Mess, or it is given by your Army Mess or Navy Mess, or it is given by paramilitary forces mess or police forces, it shall remain exempted, because when they are giving the services to their own personnel, any kind of services, basically whether it is accommodation service or whether it is any services given by all these forces, whether Air Force or your Army or your Navy or your police or your paramilitary forces, to their personnel, is exempt, because when they are giving to their services to their own personnel, they are non-business entity, it is exempt. The only thing is the supplier should be qualifying as government. So that is the clarification given by this circular. Now talking about one amendment in your reverse charge notification. So we have discussed about your amendments in your exemption notification, 3 amendments and a circular. Now we are talking about an amendment in reverse charge notification, basically, which is notification number 13 bar 2017 CT rate read along with 10 bar 2017 IT rate. There is an explanation added, or there was already an explanation. Now there is a change to that explanation. The entire RCM exemption or RCM notification said that for the purpose of the entire notification, central government, state government shall include parliament, state legislation. This was already attached. Now they have further extended and said that for the purpose of your RCM notification, your central government, state government, whereas because generally services given by government is covered by RCM. Not all services, Mostly, if at all it is accessible, majority of the services given by government is covered by RCM. Now, it was already clarified earlier that central government, state government includes parliament, state legislature. Now, it has been further clarified that your central government, state government not only includes your parliament and state legislature, but also courts and tribunals, which basically means that whether the service is by central government or state government or parliament or state legislature or court or tribunal, when they are giving the services, normally it will be covered by RCM. Not always, but normally it is covered by RCM. So be it central government, state government, basically the notification talks about central government, state government, but it was later extended to parliament, state legislature. Now it is even extended to court, tribunal, when they are giving the services covered under RCM notification. RCM notification will be there not only for your central government, state government, but also for your parliament, state legislature, and also your court and tribunals. That is the effect of amendment in your RCM notification 13/2017 CT rate read along with 10/2017 IT rate. This amendment is effective from your 28th of Feb 2023. Yes, friends, now let us talk about your amendments in your registration chapter. Now, the first amendment which is there in your registration chapter is in your Rule 8 of CGST rules, which basically talks about application for your registration. Now, what used to happen is when you are applying for registration, the basic application form is Form GST REG01. In that form, there is the first part which is called as Part A. So, in Part A of Form GST REG01, you are required to basically give 4 details, which is your PAN number, mobile number, mail ID, and the state and union territory in which you are going to take the registration. So, your PAN was the first thing, mobile number is the second thing, mail ID is the third thing, and fourth is the state or union territory in which you are going to take the registration. What have they done is, they have removed your mobile number and mail ID. Now, one may wonder why they are not taking your mobile number and mail ID in your Part A of GST REG01. Why is because when you talk about your PAN now, in your PAN number, you would have automatically given your mobile number and mail ID in your income tax database. So, now you will be giving only and only your PAN number and state or union territory in which you are applying for registration. So when you are applying for registration, your OTP will now go to mobile number and mail ID which is linked to your PAN. So you cannot give any other mobile number, mail ID. So there is no option to give any other mobile number and mail ID. Earlier, what you would have done is you would have given any mobile number, mail ID. Now, the moment you give your PAN, at the back end of the income tax database, your PAN will have a mobile number and mail ID. So, one-time password will go to the mobile number and mail ID which is linked to your income tax PAN, not to any other mobile number, mail ID. So, that is the basic amendment which has been brought to. So, this PAN will be validated online from the CBDT database, and one-time password will go to mobile number and mail ID which is linked to that PAN number, not to any other mobile number or mail ID. So basically, this is the amendment which is brought in your Rule 8 of CGST rules, effective from 26th of December 2022. Going on to the other amendments in registration, basically in the same Rule 8 is there in your Rule 8(4)(a), where you're talking about application for registration, and the continuation of that is also there in Rule 9(1) and 9(2) of your CGST rules, which is basically verification by officer. So now the next amendment, which is an amendment linked to both Rule 8 and Rule 9. So that's the next amendment. They have made changes, or they have changed your Rule 8(4)(a) to include one thing. So when you're talking about your Part B of GST REG 01, basically there were three categories earlier. Three categories. Basically, even you can call it as four categories. Now that has been subcategorized into. So now to understand what has happened both in your Rule 8(4)(a) read along with Rule 9(1), 9(2), let us understand with the help of a chart. Basically, when you apply for registration, you have to authenticate your Aadhaar. It's not mandatory, but you have to authenticate your Aadhaar. If you don't authenticate, something else will happen. So basically, you're going for Aadhaar authentication. Either you're opting for Aadhaar authentication and it is successful, or you're opting for Aadhaar authentication but it is not successful, it is failed, or you're talking about you're not at all opting for Aadhaar authentication. Finally, you're exempted from Aadhaar authentication. So there are certain notified persons, including the Department of Central Government, State Government, or local authority, or your public sector undertakings, even when you're talking about non-citizens of India, and even for your unique identification. But for all these categories, they are exempt from Aadhaar authentication. Now, earlier, when you don't opt for Aadhaar authentication or Aadhaar authentication has failed, what was there is physical verification is mandatory. Physical verification of premises. Physical verification of premises is mandatory. Physical verification of premises is mandatory. But in the other two cases, there is no mandate of physical verification of premises. But what has happened now after amendment is, even if Aadhaar authentication is opted for and is successful, now it is categorized into two. One, you're talking about non-risky category, and one you're talking about risky category. So now, non-risky category and risky category. So if you look at the BAR Act wordings, the common portal will identify based on data analysis and risk parameters whether it is risky category or non-risky category. If at all it happens to be risky category, then there will be mandatory physical verification. Physical verification of the premises will be mandatory. Also, the fact that there will be biometric verification. Biometric verification. So if you see for this risky category, there will be biometric based Aadhaar authentication. So biometric verification will be there. And what will happen in this biometric based Aadhaar authentication is that you have to give the photographs either of the individual himself or of such individual. Say for example, for partnership firm, it will be of partners. For a company, it will be of directors. So that photographs has to be given even if the applicant is not an individual. Say for example, it is a partnership firm, photographs of partners. Company, photographs of directors needs to be given. And original copy of the documents which were uploaded in Part B of GST REG 01 will be verified at facilitation centers, which is notified by the commissioner. So what will happen in this risky category is there will be the biometric based Aadhaar authentication. That will be your biometric based Aadhaar authentication. Now what will happen in biometric based Aadhaar authentication? At facilitation centers notified by the commissioners, first there will be biometric verification of your eye retina or thumb scan, plus at that place you have to give the photographs as discussed if it is proprietorship concern individual, if it is a partnership form of partners, company of directors, and so on. And there'll be verification of original documents that you have submitted. Say for example, for the premises you have submitted lease deed. At the facilitation center, you have to go and give the original lease deed. Show the original, rather than telling that give the lease deed, you have to show that lease deed. So in this risky category, what will happen is there is biometric based Aadhaar authentication. What is there in biometric based Aadhaar authentication? At the facilitation center notified by the commissioner, you have to go. You have to go with biometric based Aadhaar authentication where iRetina scan may be there, fingerprint scan may be there. You have to submit the photographs and you have to show the original documents of what all documents you have submitted in Part B of GST REG 01. Right, so this is a new amendment that has come in, and as of now this biometric based Aadhaar authentication is on trial basis, and as of now it is there only and only in the state of Gujarat. So this biometric based Aadhaar authentication is not there in any of the state throughout India except for Gujarat. So as of now you have this biometric based Aadhaar authentication only in Gujarat. So what is changed is, when you're talking about opting for Aadhaar authentication, now you have two categories. One, not a risky category, other a risky category. And in risky category, there will be physical verification of premises. Now basically, there are three places where you'll have physical verification of premises. Where you have opted for Aadhaar authentication, but it is risky, physical verification of premises is mandatory. Where you have opted for Aadhaar authentication, but it has failed, physical verification of premises is mandatory before grant of registration. Where you have not opted for Aadhaar authentication, physical verification of premises is mandatory before grant of registration. In the other two cases, physical verification of your business premises is optional. Which means if at all you are opted for Aadhaar application where it is successful and it is not risky, physical verification of premises is optional. And even when you're talking about in certain cases that Aadhaar authentication is exempt, physical verification of premises is not mandatory, it is optional. Now this is the amendment in Rule 8 Sub Rule 4A. Now what is the amendment in Rule 9.1 and 9.2? What are they trying to tell? They are telling that if at all physical verification of premises is there, wherever there is physical verification of premises, in which all cases you will have physical verification of premises? In which all cases you will have physical verification of premises? Now, the first case where you will have physical verification of premises is Aadhaar authentication is opted and it is a risky category. Second case, Aadhaar authentication is opted but it is failed. The next case is you have not opted for Aadhaar authentication. You have not opted for Aadhaar authentication, or with the prior permission of any officer authorized by commissioner not below the rank of assistant commissioner, you are going for optional physical verification. You can understand this way. In the first three cases, there is mandatory physical verification. The last case, there is optional physical verification. In all these three cases plus one case, officer will get a time limit. Officer will get a time limit of 30 days, either to grant the registration or to give show cause notice. But when there is no physical verification of premises, in that case, officer will get 7 working days either for grant of registration or for show cause notice. So if there is no physical verification of premises, officers will get 7 working days either to grant the registration or to give show cause notice. When there is physical verification of premises, obviously officer will require more time, that is 30 days, either to grant the registration certificate or to give the show cause notice, either or. And if show cause notice is given, second innings will start. If at all show cause notice is given, then again assessee will reply to the show cause notice within 7 working days, and officer finally has to either accept, that is grant the registration, or reject it. So that second innings will start if at all show cause notice is given. Now, what is the amendment that has been brought here? Earlier, you had only 3 categories where Aadhaar application is opted but it is failed, or not opted, or optional physical verification. Now, even if Aadhaar authentication is opted and it is successful, but it is a risky category, even then you have mandatory physical verification. So the amendment which is brought here is adding this category, where for this category officer will always have 30 days time, because there is mandatory physical verification, either to grant the registration or to give show cause. So that is the amendment which has been brought down in your rule 8.4a application for registration, read along with rule 9.1 and 9.2 of your CGST rules. And moving on to the last amendment of your registration chapter, there is an amendment which has been brought in your rule 12 of CGST rules, basically where we are talking about registration of GST TDS number or GST TCS number. Now understand that previously when you are talking about GST TDS number, basically taken by government or government undertakings, and GST TCS number taken by electronic commerce operator. Normally there the option of cancellation was not there. Cancellation earlier can be done or initiated only by the proper officer. Now the provision has been rectified. It is a kind of rectification amendment, and cancellation of GST TDS number or TCS number can be made by the assessee himself. Not necessarily it is done only by the proper officer. Now this cancellation can start even by assessee. So cancellation proceedings can start by the assessee also. Earlier it was allowed, or cancellation of TDS or TCS number was possible only if the department is starting it. Now cancellation of GST TDS number, TCS number can be initiated by assessee himself. So that is the amendment which is brought in your rule 12.3 of your CGST rules. And all these amendments that you discussed, the effective date of that, be it rule 12 or rule 9192 or your rule 8, basically. If you see your rule 8, basically all these amendments are effective from your 26th of December 2022. Whereas when you talk about your biometric based Aadhaar authentication, it is that amendment is brought on 31st of March 2023, but it is effective again from the same date, 26th of December. So all the amendments in your registration chapter are effective from your 26th of December 2022. So one of the amendment came on 31st of March, even that is retrospectively effective from 26th of December. Yes, friends, now let us move on to your amendments in your input tax credit. Friends, when you talk about your amendment in input tax credit, they are very limited amendments this time for your November 23 exams. First of the amendment is in your rule 37 of your CGST rules, where it talks about condition for taking the credit. Friends, you need to understand that the criteria for taking the credit are given in section 16 of CGST Act, right along with rule 36 and rule 37 of CGST rules. Basically, the main rule is rule 36. Rule 37 talks only about one criteria: if the recipient is not making the payment of consideration within 180 days, then he has to reverse the ITC. But there was an issue when there was an amendment last time. What was the amendment last time? To understand the amendment this time, the amendment said, supposing you're talking about a supplier and you're talking about a recipient. So what was the basic amendment last time? It was said that if at all you're talking about a supplier giving, say, the goods of the value of 10 lakhs plus GST at 18%, 1,80,000, supplier needs to pay output tax of 1,80,000, and recipient will claim input tax credit of 1,80,000. Now the problem with the amendment which came last time is if at all the recipient is not making the payment, if recipient is not making the payment, non-payment of both this price plus GST within 180 days, then there needs to be reversal of ITC. The problem with reversal of ITC was, assume a scenario where recipient has almost paid entire amount. So the payment which is made is out of say 11,80,000, 8 lakh amount is paid, and non-payment is not 11,80,000. It is only and only your 3,80,000. The problem with the provision was, when it was amended last time, the reversal of ITC will be of entire amount. Entire amount. What was the ITC taken? ITC taken was your input tax credit taken was 1,80,000. Now reversal of ITC as 3,80,000 is not paid within 180 days would be entire 1,80,000. So if you could understand the scenario, recipient has already made the payment of 8 lakh. What he has not paid is only 3,80,000, which is a part payment which is pending. So reversal now is said that no, you have to reverse the entire ITC. You claimed ITC of 1,80,000. As you have not made the payment of a small amount, you have to reverse the entire ITC. Now this was obviously not logical, because right from the beginning reversal was only on pro rata basis. Now the amendment is, reversal will not be of entire 1,80,000. Reversal will be only of pro rata amount. Only and only of pro rata amount. Out of 11,80,000, 3,80,000 has been, 8 lakh has been paid, and only 3,80,000 is not paid. So now after the amendment, reversal of ITC will not be 1,80,000, it will be proportionately. So 1,80,000 is total ITC for the total amount 11,80,000, but what is not paid is 3,80,000. So pro rata basis, you have to use your calculator and find this number. Obviously it will be a small number. It will not be entire 1,80,000. It is on proportionate basis. So if you see the amendment is telling that if at all part payment is not made within 180 days, only proportionate ITC has to be reversed and not entire ITC. And if you see this amendment has come on your 26th of December 2022, but it is retrospectively effective from 1st October 2022, first time when the amendment was made, which means first time amendment in this provision was made that you have to reverse full ITC on 1st October. Now, right from the beginning of GST, if the part payment is not paid, only proportionate ITC needs to be reversed to that extent. But on 1st of October, when the rule was amended, it said that you have to reverse the entire ITC. Now they want to nullify that effect. Therefore, if you see this amendment, it has come out on 26th of December 2022, but it is retrospectively effect from 1st of October 2022. What is 1st of October 2022? That was the date when this illogical provision of reversing full ITC was there, even if part payment is made. So that is the reason why it is retrospectively effective. So that is the amendment in your Rule 37. If at all you have partly paid the amount, your part payment, to the extent of part payment, ITC will not be reversed. Only to the extent of non-payment, your proportionate ITC will be reversed. And it is retrospectively effective, which means that right from the beginning of GST, 1st of July 2017 till date, it is always proportionate reversal of ITC. It's always that. Now, talking about the next amendment, which is in form of a new rule. So, one of the conditions which is added, previously when you're talking about your ITC, the conditions for taking the credit were given in section 16, read along with rule 36 and rule 37. Now they have brought out a new rule which is Rule 37A. And the birth of this Rule 37A seems to be, there's a provision called as Section 41. So now when you're taking the credit, still taking the credit is based on Section 16 along with Rule 36 and Rule 37. But because of Section 41, it has given a birth to a new rule called as Rule 37A, which is bringing a new condition. Rather, it is diluting other condition and bringing a new provision. So what it is trying to tell? It is talking about a scenario, if at all supplier has not paid the tax, recipient has to reverse the credit. That's the basic logic. So this point was right from the beginning, that if supplier did not pay the tax, recipient has to reverse the ITC. Very simple understanding. Supplier, you pay the tax and recipient will get the input tax credit. To that extent, that was very clear-cut understanding. Now, what is the amendment that is brought in? How to find out whether supplier has paid the tax or not? This gives birth to your Rule 37A. It tells that where input tax credit has been availed by the recipient in his GSTR 3B for a tax period in respect of that debit note or invoice which has been furnished by the supplier in his GSTR1, which means obviously that's a criteria which was already there. Supplier has to file GSTR1 and the recipient will get the credit in GSTR2B, based on which he can take the credit in GSTR3B. So there's no change to that extent. Either the supplier will file his outward supplies in GSTR1 or invoice furnishing facility, and based on that recipient will take the credit. But what is the new provision telling? That recipient, you have availed the credit based on supplier filing GSTR1 or invoice furnishing facility. But that supplier has not filed GSTR 3B. Has not filed GSTR 3B. Till which date? Till 30th of September of the end of the financial year in which ITC is claimed, which means till 30th of September of next financial year. Then whatever ITC recipient has taken, it has to be reversed. Right? It goes on. Right? It has to be reversed in that return on or before 30th of November. Though supplier should have filed this GSTR 3B and paid that amount on or before 30th of September of next financial year. But if at all you're talking about a scenario where supplier has not done that, then recipient has to reverse the ITC in his GSTR 3B of the subsequent month. It means that we are talking about October month, which is to be filed on or before 30th of November of the next financial year. And it also tells that if at all, in spite of this provision where supplier has not filed his GSTR 3B supplier has not included that outward supplies in his GSTR 3B till your 30th of September of next financial year, and recipient has not reversed that ITC till 30th day of November of next financial year, then recipient has to reverse that ITC along with interest calculated as per section 50 subsection 3, which means if at all you're not doing a reversal before 30th of November of next financial year, please reverse that ITC with interest. Now it further goes on to tell that in a scenario where supplier subsequently furnishes this GSTR 3B and pays the tax, recipient can re-avail the credit in GSTR 3B of the tax period thereafter. What are they trying to tell? Let us understand this with a scenario. See, the basic criteria is supplier, you have to file your GSTR1 so that the recipient gets it in GSTR2B. So please first make it very clear, if at all a supplier has filed his outward supplies in GSTR1 or invoice furnishing facility, only then recipient will get in his GSTR2B. We are not going to see GSTR2A, which is dynamic. We are going to see GSTR2B, which is static. And only then credit can be taken. So this is very clear. Only and only after supplier furnishes outward supplies in GSTR1 or IFF and it is reflected in GSTR2B, credit can be taken. So credit can be availed only then. This is the first criteria. First criteria. Now they're telling that no, not only this. Not only this. Supplier should also have paid the tax and included the transaction in GSTR 3B. Please understand that payment is only made when that sale is shown in GSTR 3B. A supplier might have shown that sales in GSTR 1 or IFF, but might not have included that outward supplies or sales in GSTR 3B. Understand that there is no payment along with GSTR 1 or invoice furnishing facility. Payment is only there in GSTR 3B. So the next criteria tells that supplier should have paid the tax, included that outward supply or sale transaction in GSTR 3B. Understand that there is a difference between the first criteria and the second criteria. The first criteria, only and only when supplier files his GSTR 1 or IFF, only then recipient will get that in GSTR 2B, and only then recipient will claim that credit in his GSTR 3B. Claim that credit in his GSTR 3B. So availment of ITC will be done only that. Supplier has to file his GSTR 1 or IFF. Recipient will get that in his GSTR 2B, which is auto populated. Only then recipient can claim ITC while filing GSTR 3B. That's the only criteria. If that is not done, this will not happen. But when you're talking about the second criteria, supplier may not have included that outward supply or sale transaction in GSTR 3B of that month. Payment might have happened late. And if supplier includes that in any of his return on or before 30th of September of next financial year. 30th of September of next financial year, no need to worry. So if supplier is including that, outward supplies on or before 30th of September of next financial year, there is absolutely no worry. Absolutely, if it is done, there is nothing to worry. If it is not done, then recipient has to reverse the ITC. On or before, in a return on or before 30th of November of next financial year, which means reversal of ITC either it should be in September return or October return. Reversal of ITC should be there in his return, which means in his 3B return, which has to be filed. So it is not November 3B return. That reversal of ITC will be there in recipient's GSTR 3B return, which is filed before 30th of November of next financial year. Let us understand this again. Supplier should include that sale transaction on or before 30th of September of next financial year. If it is done, nothing will happen. If it is not done, then recipient will reverse that ITC in GSTR 3B of subsequent month, which is filed on or before 30th of November of next financial year. Basically, recipient is going to reverse ITC either in September month return or October month return to be filed on or before 30th of November. If not done before that, then it will be along with interest at 18%, and that interest will be from 1st December of next financial year. So interest will be from that. Basically, if you understand this criteria, one will surely have a doubt. And this is basically the provision. The provision goes on to tell us that in case reversal happens and supplier pays the tax thereafter. Finally, supplier pays the tax late thereafter. And if at all you have already reversed the credit, you can reclaim the credit. Reavail the ITC. But not the interest portion. Interest paid will be cost. So finally, if supplier is finally paying that tax on outward supplies, but not before 30th of September, which means it is done later. Then you can re-avail that ITC, whatever you have reversed, but not interest portion. Please understand the issues here. First of all, understand that there was no need of having this point called as 30th September. There was absolutely no need. It could have been very well said that if supplier is not paying the tax in any of his return on or before, filed on or before 30th November, then recipient has to reverse it with interest. That's it. Interest will start from 1st December. Why I am telling that there was no need of 30th September is, assume a scenario where supplier is paying the tax after 30th September. Assume a scenario, which means say supposing supplier is paying tax in October return of next financial year. Right? Provision tells that you have to reverse the ITC and you have to reclaim ITC. So there's no need of reversal, there's no need of reclaiming, because recipient has to reverse the ITC on or before 30th of November of next financial year. So supplier has paid the tax in October return of next financial year. So strictly speaking, the provision tells that recipient has to reverse, but recipient has to reverse when? On or before 30th of November. And the recipient will not reverse it because though supplier has paid the tax after September 30th, it has been included in October return of next financial year, and recipient was having time for reversal till 30th November of next financial year. So recipient will not at all reverse the ITC. There's no question of any interest, no question of reavailment. So this 30th September is basically unwarranted. Basically, you understand, you can understand this in a very simple way, that if supplier is paying the tax and reflecting in any of the return filed before 30th of November of next financial year, recipient need not reverse the credit, and if it is not done, then recipient needs to reverse the ITC in his 3B return, basically not November return, any return on or before October return, and reverse with interest. Maybe this time gap between 30th September and 30th November between supplier and recipient is only to ensure that recipient is ready. That could be the intention of the lawmakers. Otherwise, 30th September of next financial year really doesn't make sense. So the intention of the lawmakers is, see, your supplier has not yet filed on or before 30th of September of next financial year. Inform the supplier and ask him to pay the tax. If he has paid it in October return, well and good. Then there is no need of reversal of ITC, no need of interest, no need of reclaiming. If he has not done before 30th of November of next financial year, then you reverse in your GSTR 3B, not November 3B. It is up to last month is October GSTR 3B, because that has to be filed on or before 30th November. November 3B will be filed after 30th November. So any return to be filed before 30th of November of next financial year, which is basically October month return is the last return of the next financial year, in which you have to reverse that ITC. And if you reverse that on or before 30th of November of next financial year, no interest. If you reverse thereafter, interest will start from 1st of December of next financial year. And as and when supplier is paying that tax and including in his GSTR 3B, recipient can re-avail the ITC. Now, the first issue that I pointed out, issue number 1, this 30th number is unwanted. Issue number 2, supplier may not pay that in his GSTR 3B. He may pay by voluntary payment DRC 03 challan. So here they should have said that supplier is paying the output tax on such outward supplies either in his GSTR 3B or by DRC 03. Either or. So here issue number 2 is, they are telling that for reclaiming the ITC, supplier should have included in his GSTR 3B after 30th of November, and where recipient can revalue the ITC but not the interest. So it is possible that supplier is not paying that tax or including that tax in GSTR 3B, but he is including that in DRC 03 challan. So they should have addressed this voluntary payment by DRC 03 challan, which is not addressed. That is issue number 2. Issue number 3. See, basically understand that GSTR 3B is a proof of filing. In GSTR 3B, there may be non-payment of tax or short payment of tax. As a recipient, you might see whether the supplier has filed his GSTR 3B or not. You can ask the supplier and he can give the proof. Or through private software, you can check whether the supplier has filed GSTR 3B or not. but you cannot check whether your outward supplies is included or not. So issue number 3 is given in form of author's note, where it is addressed that your section 37A is coming out of your section 41. Section 37A is only concerned with GSTR 3B of the supplier, ignoring short payment of taxes by the supplier, which means that supplier might have filed his GSTR 3B, but it is still possible that supplier has not paid the full tax. Now, government is assuming that if supplier is filing GSTR 3B of that month, including that sales, it is assuming that supplier has paid the tax. But it is highly impossible for the recipient to verify about the payment of tax by the supplier. All he can do is he can check whether the supplier has filed GSTR 3B for that month or not. So, if GSTR 3B is not filed by the supplier, recipient has to reverse ITC. But GSTR 3B can be filed by the supplier with short payment of taxes or not including that taxes. Now in that case, recipient is not required to do anything. So this assumption of the government that when supplier files his GSTR 3B, it means that he has included the outward supplies of the sales and paid the tax. This assumption will go for a toss, and recipient will not be under any position to check that whether supplier has included his transaction in his GSTR 3B. Recipient can check whether supplier has included his transaction in GSTR 1 or IFF, but not check whether the supplier has included his transaction in GSTR 3B. So this criteria is in fact diluting the condition of payment of tax by the supplier. Yes, payment of tax by the supplier can be checked by the officer later again. But as of now, you're asking the recipient to reverse the ITC based on supplier not filing his GSTR 3B or not including his sales in GSTR 3B of that month, which basically makes this provision coming out with certain issues, the issues that we have discussed. Now let us understand this, both the criteria that we have discussed with the help of an example. Let us see example 1. Supplier has supplied you on 25th of April, included in GSTR 1 of April month, which is filed on 10th May. So recipient will get that credit, recipient will get that ITC in GSTR 2B of April itself. Therefore, recipient will avail the ITC in April 2023 GSTR 3B return itself. Supplier has paid the tax while filing his GSTR 3B. That sale transaction is not included in April month return, but it is included in July return of next financial year. The sale happened on April 2023, included in GSTR 1 of April 23. Sale happened on April 23, 25th April, included in GSTR 1 of April 23, and that April 23 GSTR 1 was filed on 10th of May, which came in GSTR 2B of April 23 for the recipient, and recipient took that credit. Recipient took that credit in April 23 GSTR 3B return. Supplier included that sale transaction and paid the tax while filing GSTR 3B of July 24, which means July 24 is next financial year. Now, whether the condition number 1 as discussed is supplier should have included in GSTR 1 or IFF, recipient will take the credit, that is satisfied. Condition number 2 is supplier should have included that sale transaction, but that need not be checked real time, that can be checked later on. If at all I want to avail the ITC, all I need to check is whether supplier has included that transaction in GSTR 1 IFF, whether I have got in my GSTR 2B. If yes, I'll take the credit. Supplier, whether he has included the transaction in 3B, I need not check real time. I have time. Supplier can include the transaction in GSTR 3B of any month filed before 30th of September of next financial year. In this case, yes, it is filed before 30th of September of next financial year. Nothing will happen. Recipient has already taken the credit. There is no question of reversal of ITC. Right. Now let us see the next scenario. Now what has happened is, again we have taken the same example. Supplier has made a supply on 25th of April 2023, included in GSTR1 of April 23 month itself, but filed on 15th May. So the sale transaction happened on 25th of April 2023 for the supplier. Supplier has included that in GSTR1 of April 23 itself, but that is filed late. So this will be reflected in GSTR2B of the recipient, not of April 23 month, but of May 23 month. So recipient will take that credit while filing his GSTR 3B return. That availment of credit will happen only in May 2023. So that's the difference in example 1. In example 1, supplier made the supply on 25th April, included in GSTR 1 of April 23, but filed on time, filed on or before 13th. On or before, if at all you're talking about GSTR 1, it was all filed before it was reflected in GSTR 2B. So it was filed before that time. Now in this case, it is filed after the time, that is the 13th May is the deadline. It's filed after that time. Therefore, though supplier has included that in April GSTR1, recipient will get that in 2B of May. Supplier has included in April 23 GSTR1, but recipient will get that item reflected in GSTR2B of May month, and recipient will take the credit only in May return, not in April return, not in April return. So first condition is supplier, you file your GSTR1 IFF. If at all filed on or before the due date, then it would have been taken in that month itself. If at all April month return was filed before the due date, then recipient would have taken the credit in April 23 itself. But supplier has filed GSTR1 of April after the due date on 15th May. So recipient will get that transaction only in GSTR2B of May 23, not of April 23, and recipient will claim that ITC only in May 23 return, not April 23 return. So that is a change. Supplier has paid the tax. Now that sale transaction or output supply transaction was not included in GSTR 3B of April. It was included in GSTR 3B of September 2024. It was not included in GSTR 3B of April 23. It is included in GSTR 3B of September 24, which means you're talking about September of next financial year. And that September month return was filed on or before October. Understand that supplier has included that transaction after September of next financial year, but recipient has got that before 30th November of next financial year. In that case, there is no need of reversal. There is no need of any reversal. Though supplier has included in GSTR 3B filed after September of next financial year, but recipient had time, extra time. Recipient had cooling period of 2 months. Recipient got that before 30th November of next financial year, because supplier included that, though it is after 30th of September, supplier included that in September return, filed on 25th of October 2024. So it was between this time. Supplier did after 30th September, but recipient got before 30th November. So there is no need of reversal of ITC. There's no need of reversal of ITC. As discussed earlier, the 30th September is not so important. Remember, finally, it should have been included in supplier's GSTR 3B filed on or before 30th November. The recipient need not reverse the ITC. If at all it was not reflecting before 30th November of next financial year, then recipient should have reversed the ITC. And finally, let us see your example 3. Supplier has made a supply, output supply on 25th April 2023. Included in GSTR 1 of April 2023, filed on 15th May. Filed on 15th May. As it is not filed on or before due date, that is for April month, we are assuming that we are talking about finally, it should have been, though the due date is 11th May, it should have been done before 13th of May, because 13th of May your GSTR 2B will be ready. So as it is not done before that due date, it will not come in GSTR 2B of your April month. It will come in GSTR 2B of May 2023. It is not going to be reflected in GSTR 2B of April 23. So recipient will avail that ITC, yes, but only in May 2023 return and not in April 2023 return. So this is basically the same as the previous example. Supplier has included that sale transaction or outward supply transaction in GSTR 3B of December 24, which means you're talking about GSTR 3B of a return in next financial year, which is December 24 return is filed on January 25th, 2025. Now, what will happen is recipient now has to reverse the ITC. Recipient now has to reverse the ITC in any of the return, whether it is September return or October return filed before 30th of November 2024. So recipient has to reverse the ITC this time because the payment has been made by the supplier by including the transaction GSTR 3B of December of next financial year. So reversal should be done in any of these returns, whether September return or October return filed before 30th, whether in September return or in October return, that is September 3B or October 3B, but filed before on or before 30th of November 2024. If not, interest will be there at 18% per annum from your 1st December 2024. If you reverse before that time, no need of interest, otherwise interest. And second stage, as supplier finally pays the tax on the transaction by including the transaction in December 2024 return filed on 25th. So there will be re-availment of that ITC, while filing Jan 2025 return. So why there will be re-availment of ITC? Because supplier has finally paid the tax by including in December of return of next financial year, and recipient will come to know only in January month. So recipient can claim the credit only in January 2025 return, which when he is filing his Jan 25 GSTR 3B return, he will reclaim the credit. If at all there was late reversal and that was with interest, the reclaim will be only of ITC, not that of interest. So that is all about the amendments in your ITC chapter. Yes, friends, now let us see the amendments in your document and your e-waybill chapter. Small amendments are there. The first of the amendment that you could find is in your Rule 46 of your CGST rules. Basically, there is a Rule 46 sub-rule F which tells that the recipient's name and address is not required if at all you're talking about the value being less than 50,000. But there's a proviso now attached to this sub-rule which tells that if at all you're talking about any taxable service, first of all, they are not talking about goods. They are also not talking about exempt service. So it is neither for goods nor for exempt service. This proviso is only for a taxable service, and that too it is supplied either by electronic commerce operator or through electronic commerce operator. So the supply is by ECO or through ECO or by a supplier of OIDAR service, right, to a recipient who happens to be unregistered recipient, irrespective of the value. Even if the value happens to be less than 50,000, even then it shall contain the name and address of the recipient. Not only that, it shall be there along with the PIN code and the name of the state. This is only to ensure that it is very easy to identify the place of supply in such case of supply of taxable services through ECO or by OIDRS to unregistered recipient, and so that the revenue goes to the correct destination state. What are they trying to tell you? Basically, Rule 46F tells that if at all the value happens to be less than 50,000, name and address of the recipient is not required. There is an exception to it. What is that exception talking about? If the supplier is ECO or supplier is through eco, or supplies of online information database and access and retrieval services, online information and database access and retrieval services. In that case, and if the recipient is unregistered recipient, and if the recipient happens to be unregistered recipient, then whether the value is less than 50,000 or more than or equal to 50,000 does not makes any difference. There should be name and address of the recipient with entire pin code, state, and the pin code, so that the revenue goes to, this is only and only to ensure that it is very easy to identify place of supply and the revenue reaches the destination state. Is this applicable for everything? No, it is not applicable for your goods. It is not applicable for your exempt service. It is only applicable for your taxable service. So supply is of taxable service, supplier is eco, or supplier is supplying through eco, or supplier is providing OIDRS services to the unregistered recipient. So there are three criteria. Criteria number 1, supply is of taxable service. 2, who is the supplier, eco or through eco or OIDRS. 3, recipient is unregistered recipient. And in such cases, whatever is the value, there should be name and address of the recipient along with the state and pin code, so that it is very easy to find out place of supply and the revenue finally goes to the destination state. So that is the amendment in your rule 46. Now the next amendment, that's all about this amendment which was that in rule 46. The next amendment is in rule 46A. That is more of clarificatory in nature. So when you talk about a combo document, which is invoice cum bill of supply, which is only when the supplies of taxable goods, services and exempt goods and services together to an unregistered recipient. So supplies of both taxable and exempt goods and services, and both are given to together to an unregistered person. The document which will be there is invoice cum bill of supply. In that case, this combo document, single invoice cum bill of supply, shall contain the details of invoice given in rule 46 as well as your bill of supply given in rule, invoice content of invoice given in rule 46 special cases rule 54, as well as it shall contain the details of bill of supply given in rule 49. So it is telling that as it is a combo document, invoice cum bill of supply, it shall have the details of tax invoice as per rule 46 read along with rule 54. It shall also have the details of the contents of bill of supply. This amendment is more of clarificatory nature. It was right from the beginning the same. And both these amendments in rule 46 as well as your rule 46A are effective from your 26th of December 2022. Now the amendment which has come in your e-waybill provision, that is rule 138. So when you talk about annexure to rule 138 sub rule 14, it tells that for the following items, for the following cases, e-waybill is not required. And one of the item that you see in annexure to rule 138 sub rule 14 is when you're talking about jewelry, goldsmiths and silversmiths, wares and other articles under chapter 71. So jewelry items, there is no requirement of e-waybill. Now they are talking about an exception. Imitation jewelry, which is again covered in your chapter 71, heading 71(1)(7). For imitation jewelry, now they are telling that no, e-waybill is required. So basically for jewelry, e-waybill is not required, but for imitation jewelry, now that exemption is removed and e-waybill will be required. So because the exemption is removed, therefore e-waybill will be required. So this is also effective from your 26th of December 2022. So that is an amendment in your e-waybill. Now there is a circular which is talking something about your e-invoice. So what is that circular? The circular is basically telling that when you're talking about exemption from e-invoice, whether the exemption which is from e-invoice is for the entity as a whole or in respect only of certain supplies. If you see the exemption, in the exemption list you will find even banking sector. So the circular is taking the example of banking sector and it is explaining whether banking sector is involved in supplying banking services or involved in making supply of some goods. Say for example, say there is a sale of capital goods. The exemption from e-invoice. Exemption from e-invoice is not only for banking services but also for other supplies, say for example supply of capital goods for banking. So it is clearly telling that this exemption is for entity as a whole and not restricted to particular transaction. So if at all you're talking about that exemption, one of the exemption which is there from invoicing is for banking sector, that is banks, financial institutions and non-banking financial companies. So whether it is banking services, there's no requirement of invoice, or whether is there some other supply, say for example supply of capital goods, even for that there's no requirement of e-invoicing. So this is the clarification, clarifying the scope of exemption from e-invoice. Yes friends, now let us discuss about your amendment in payment chapter and your return filing chapter. So let us first start with your payment chapter. There is an amendment in your electronic cash ledger, rule 87. So that amendment basically is talking about a scenario where you have made the payment. You have made the payment, but you have not got the details of challan identification number on the common portal. So the payment is made, debited from your bank account, but the details are not reflected, which means you don't get your challan identification number on the common portal. Then your cash ledger may still be updated, though you don't get a challan identification number, but still your cash ledger may still be updated on the basis of e-scroll of RBI in case the details of e-scroll of RBI are matching with the details in challan generated in PMT 06, which basically means that they are giving an additional step. If at all, whenever you make the payment and it is debited from the bank account, but SIN is not generated. Now, even though SIN is not generated, your electronic cash ledger may still be updated on the basis of e-scroll of RBI if at all the details are matching with the challan. And in case, assume this is only an additional step. If it is not matching, then obviously the last resort for a person is to make a representation electronically on common portal to the bank or the electronic gateway through which the payment is deposited and tell that, see, I've made the payment. You have to put a grievance on the common portal telling that I've made the payment, but still it is not reflected on the portal, though the amount is debited from the bank or the electronic gateway through which the payment was initiated. So they have added an additional step. You have made the payment, but still you have not got the challan identification number. Don't worry. If at all the details of your challan are matching with e-scroll of RBI, again your cash ledger will be updated. But if that is also not matching, then the last resort was already available to you. You have to go on the common portal and put your grievance and intimate the bank or the gateway telling that my payment is not yet reflected on the portal. So that is the amendment in your rule 87, electronic cash ledger. Now the next amendment is the introduction of a new rule, which is rule 88C, a very new rule, rule 88C, where it tells that the details of outward supplies reflected in GSTR1. So your outward supplies that you are reporting in GSTR1 is more than that of GSTR3B. So your outward supplies that you have reported in GSTR1 is more than that of your GSTR3B, which may lead even to cancellation if you see your cancellation provision. But now we are not discussing about that. Basically, what this rule 88C is trying to tell. This rule 88C is trying to tell that if at all a person has filed his statement of outward supply, that is sales, either in GSTR1 or invoice furnishing facility for a tax period, and that is more, that is sales and output tax is more in GSTR1 or IFF compared to your GSTR 3B. Now, when you're talking about more, they tell a very clear cut point that it should be more by such amount and such percentage. So they talk about amount and percentage which is yet to be notified. It should be more than GSTR 1 outward supplies and tax on it should be more than GSTR 3B, such amount and such percentage as may be notified by GST Council, which is yet to be notified. Then in that scenario, that person will get an intimation on the portal in form of GSTR DRC 1B. GST DRC, GST, not GSTR, GST DRC 01B. It will get that intimation in part A of GST DRC 01B. Right, where it will get on the common portal. Also, that intimation will be mailed to the mail ID. So automatically it will be put on the common portal and it will also be sent to the mail ID, highlighting that differences. So if at all your outward supplies and the tax payable on it is more in GSTR 1 or IFF compared to GSTR 3B by such amount and such percentage, then you will get an intimation in part A of DRC 1B, 01B. That will be there on the portal as well as the mail ID. What it will tell, highlight the differences. And then this particular person, assessee, will have two options. Either to pay that differential amount with interest or explain the reason for the difference. Either pay with interest or explain the reason for that difference. There can be reasons why this difference is there, and that needs to be done within 7 days. So when you're talking about either making the payment or explaining that, if you're at all you're making the payment, it should be paid by your voluntary challan GST DRC 03. If at all you're explaining the difference, it will be explained in part B of DRC 1B. So when you are making the payment, that payment should be closed by GST DRC 03. If at all you are not making the payment and you are explaining the differences, it is by part B of GST DRC 01B. And in case they give the last resort to the department, in case that amount remains unpaid plus explanation is not given or explanation given is not satisfactory, amount is unpaid plus no explanation, or amount is unpaid plus explanation given but not found satisfactory, then that amount is directly recoverable without any show cause notice and order, directly recoverable in terms of section 79. So when you talk about direct recovery, there is no need of show cause notice, there is no need of demand order, there will be direct recovery. Right, so the basic steps are, if at all there is any difference between your outward supplies between GSTR 1 and 3B by such amount or such percentage, the officer will give you DRC 01B. It will be there on portal and it will come to a mail ID. Either you have one option to pay that with interest, DRC 03, or to reply the reason for differences. It is part B of DRC 01B. Reply the differences. And finally, if you have not paid that amount and not replied, or not paid that amount, replied but not satisfactory, then that will be directly recoverable. When I tell direct recovery is there won't be any show cause notice demand order. There will be direct recovery in terms of section 79. So that is the new rule talking about rule 88C. And all these amendments are effective from 26th of December 2022. The corresponding effect of this new rule, which is coming on 26th of December 2022, is an amendment in your return filing chapter. So if you see your return filing chapter, the first amendment in return filing chapter is in rule 59, which is for your GSTR 1 and IFF. So there is a corresponding effect. There is a corresponding effect in your GSTR 1 IFF. Now, what is that effect? If at all you're receiving that intimation, if at all for a tax period, you are getting that intimation as per your Rule 88C. This is a corresponding effect because of Rule 88C. If you are getting an intimation as per Rule 88C, you cannot file GSTR1 IFF of the subsequent month. Say for example, you are getting that intimation based on Rule 88C in June month. You cannot file IFF or GSTR1 of July 2022. But understand that this restriction is valid only till the time the payment is made or reply is given. Which means you are getting that intimation in June as per Rule 88C. Your GSTR1 or IFF cannot be filed from July 22. But if you have given the reply, or if the payment is made, if the payment is not made, reply is not filed, from July 22 onwards, your GSTR1 IFF will be blocked. But if you have made the payment or filed the reply, then again you can still go ahead and file your GSTR1 or IFF of July 22. So basically it is telling that for those who have got intimation as per Rule 88C, they will not be allowed to file their GSTR1 IFF from the subsequent tax period. So that is the basic point. But there is an exception. Exception is if at all you have paid that amount or if you have replied, then you can still file IFF or GSTR1 of the subsequent month. So that is a corresponding amendment in your return filing chapter in your Rule 59. Now the next amendment in your return filing chapter is rationalization of late fees for annual return. So when you talk about your section 47, it talks about the late fees. And when you talk about the late fees for annual return, under section 44, annual return which are filed under section 44, the basic late fees for your annual return was, basic late fees, it was rupees 100 per day subject to 0.25% of state or union territory turnover, whichever is lower. This is CGST late fees, copy paste SGST late fees. So prima facie, when you see your section 47, you will find the late fees as rupees 100 per day or 0.25% of state turnover, or turnover of the state or union territory, whichever is lower. This is CGST late fees, copy paste for SGST late fees. Now they have rationalized it. What's rationalization they have brought out? They have categorized it. If at all your aggregate turnover up to 5 crores is up to 5 crores in that financial year, not the previous financial year, the financial year for which you are filing your annual return, then the late fees is rupees 25 per day, not 100 per day, subject to a maximum of 0.02% of the state turnover. So 100 per day suddenly becomes rupees 25 per day. 0.25% of state turnover becomes 0.02% of the state turnover. Copy paste is for SGST late fees. Assume you're talking about your annual return where your turnover is 1 crore and there is a delay of 75 days. So it will be rupees 25 per day for 75 days or 0.02% of state turnover, whichever is lower. In this case, if you calculate, the lower portion will be 1,875. If I tell that for the same case, you're filing annual return where your state turnover is 1 crore and now the delay is not for 75 days, it is for 100 days. So it is rupees 25 for 100 days or 0.02% of state turnover, 1 crore, whichever is lower. In this case, the lower amount will not be 1875, it will be 2000 rupees. It will be 2000 rupees. So here it was basically 1875 or 2000, whichever is lower. Here it is basically 2500 or 2000, whichever is lower. And basically understand that this is CGST late fees, copy paste for SGST late fees. This is the first part. The second part, if at all your aggregate turnover, now you're not talking about the conceptual part, is based on aggregate turnover. If at all your aggregate turnover, not state turnover, if at all your aggregate pan-India turnover exceeds 5 crores, but it is up to 25 crores in that financial year. Please understand that for checking in which category you're falling, you're seeing pan-India turnover and you're seeing turnover for the current financial year, not previous financial year. You're seeing pan-India turnover and not state turnover, because conceptual point. So if you're checking whether you're big or small, you see pan-India turnover and you see that financial year, because you're going to file annual return in the next financial year. So you're not seeing for the previous financial year. Now it is from 5 crores to 25 crores. In that case, your late fees is 50 per day. CGST late fees 50 per day, subject to maximum of 0.02 percentage of state turnover in state or union territory. So the second slab, that percentage is the same, 0.02 percentage of state turnover, but now it becomes rupees 50 per day. Now let us understand. If I tell your turnover is 10 crores, your aggregate turnover, not state turnover, your aggregate turnover is 10 crores, and there is 75 days delay. So it is rupees 50 per day for 75 days or 0.02 percentage of 10 crores. 0.02 percentage of 10 crores, whichever is lower, which will give you 3750. It is CGST late fees, copy paste for SGST late fees. If I were to tell that no, your turnover is 10 crores, aggregate turnover, not state turnover, though it is in the example it is talking about state, but conceptually you are going to see aggregate turnover, which category you're falling, 5 crores to 25 crores, 10 crores, and the delay is of 100 days. So it is rupees 50 per day for 100 days or 0.02 percentage of state turnover, which is lower. So here you will find rupees 50 per day for 100 days is 5,000 and 0.02 percentage of 10 crores is also 5,000, which is lower is you will get the same amount, 5,000. This is CGST late fees, copy paste for SGST. Whereas in the previous case, rupees 50 per day for 75 days is 3750 or 0.02 percentage of 10 crores 5,000, which was lower was 3750. We have paid CGST rate fees, copy paste for SGST. And finally, if your aggregate turnover, it's not state turnover, pan-India aggregate turnover. If your pan-India aggregate turnover of that financial is more than 25 crores, it's not state turnover, pan-India aggregate turnover of that financial year, then the normal late fees, it is now rupees 100 per day, subject to a maximum of 0.25 percentage of turnover inside the state or union territory. Normal late fees. So if I had to tell that no, your turnover happens to be 50 crores, more than 25 crores, and the delay is of 75 days. So it will be rupees, now it is 100 per day for 75 days or 0.25 percentage of that state turnover, which is lower. So which will be 7,500. This is CGST late fees, copy paste for SGST. For the same situation, if at all your turnover is 50 crores, more than 25 crores, aggregate turnover, and the delay is for 100 days, it is again rupees 100 per day for your 100 days or 0.25 percentage of your state turnover 50 crores, whichever is lower. Again, you will get the late fees of 10,000. So you have to just calculate it. You have to remember the slab. If your aggregate turnover is up to 5 crores, then it is 25 per day or 0.02 percentage of state turnover, whichever is lower. CGST late fees, copy paste for SGST late fees. If your aggregate turnover for that financial year is 5 crores to 25 crores, exceeds 5 crores but up to 25 crores, then it is rupees 50 per day, not 25, rupees 50 per day, subject to maximum of 0.02 percentage of state turnover, whichever is lower. CGST late fees, copy paste for SGST late fees. But if your aggregate turnover, pan-India turnover for that financial year crosses 25 crores, then it's normal late fees, rupees 100 per day, subject to a maximum that is point subject to maximum 0.25 percentage of state turnover, that is rupees 100 per day, or 0.25 percentage of state turnover, whichever is lower. The CGST late fees, copy paste for SGST late fees. So that is rationalization of late fees of annual return. We have already discussed that there is late fees rationalization for GSTR 1, GSTR 3B, GSTR 4, and even your TDS return GSTR 7. So there is already rationalization of late fees of 1, 3B, 4 and 7. Now there is a rationalization of late fees for your GSTR 9, 9A as well.